Good morning, good afternoon to everyone, and thank you for joining us in this Natixis webinar. Sorry for the slight delay. The idea today was to share some thoughts on the macro picture, which is obviously very complicated these days, and inflation remains the name of the game. But there are not only inflation central banks; we still have some challenges going on, and COVID is among them. So Patrick won't be able to be with us today. He just get ill, so sorry for that. You will be suffering only me today to discuss this topic together. So in the next 45 minutes, I suggest, well, you as usual, keep sending your questions. The more interactive is it, the better. So for me to try to answer your question you might have on this scenario, you probably have some. We do have on your own. Clearly, the scenario is very complicated this day. The question is not if we are going to have a recession, but when. What I'm going to try to say is that it's not such an obvious thing. Yes, the scenario is very complicated. Inflation is everywhere, so it's not only Ukraine war. It's a global phenomenon. So central banks have to be reactive like never before in terms of magnitude of rate hikes. That's totally unheard of since the 80s. So we are very back to the 80s on many aspects these days. But this is a global phenomenon. So once again, inflation is the name of the game to see where central banks are going, to see where the purchasing power is heading to, and where the global economy is probably meant to be. So to start with, as usual with Patrick, we like very much to look at where the inflation is coming from. So just as a matter of introduction, if I may, probably what is new or what is not new, which is there, is probably as well not only the bottlenecks, post-COVID bottlenecks, it's not supply chain, it's not only invasion of Ukraine by Russia, but it's as well the we start to see, and already it's a long-term phenomenon, but we really have seen this summer the effect of the global warming on the economies. Why am I saying that? Because we see that the food prices are skyrocketing. Okay, Ukraine and Russia, it's 30% of global wheat sold in the world, but we have seen that potatoes are down 20% in France, soya is down to 15%. We see that Italy, with the global the super hot summer and very low level of water, all the fruit and vegetables are in danger, and we're talking about 30% in some regions in danger. So clearly we start to see this new phenomenon of global warming on economy. So on food prices, that's an obvious thing, and probably that's a long-lasting one. So when we try to see what are the structural factors of inflation, global warming is clearly one of them on food. I will be back on energy prices, but on food, clearly so. It's not going to improve anytime soon. And look at that. Probably 2022 in Europe is the hottest summer on record. In Europe, just been published this morning, and the latest record was last year. So we were clearly in an acceleration path there, and you can see that every single vertical line is 1 year, and you are seeing that we don't know where we are going to be, but clearly more in the red, so in a hotter world. Today we at 1.1 worldwide of warmer temperature compared to pre-industrial level. When we look at where we are heading to, if we keep going on like that, we are going to be around 4.7 degrees more. So you can see that what we have seen in terms of extreme events, in terms of flooding, in terms of tsunamis, in terms of any name it, fire, or problem of agriculture, is going to stay. I was mentioning food prices, but think of electricity. I will be talking about that later. But look in China, 20% of electricity is coming from water in a sense of hydro, and you have 50% of the country of China which was in a severe drought this summer. summer. So obviously they had to cut some supply chain as well due to this global warming. So clearly the path that we are heading to, it's much more extreme than the current one that we have seen this summer. If we all together do what we have pledged to do in Paris Agreement, and you know that every year we pledge some more, but the problem is that if we do that, we are still in a path of 2.7% degrees. So the global emission of carbon are still growing, whatever we say. What matters is what we do, and we are clearly there. Just trying to do that as an introduction, because the big picture is probably more than what's happening in Ukraine or something like that. This is another structural factor pointing towards higher inflation going forward. Food prices, energy prices are going to be concerned by that clearly. And you see, and just another illustration of that is that depending on what we're doing, look on the right-hand side, the world, the global picture, you can see if the world is plus 1.5% degree more, which is what we agreed on, we're trying to reach. Well, this is still warmer, especially in the poles of the world, of the globe. But if it's 3% more, this is a totally different story. You see much more flooding, much more disruption. So this is not a linear problem. This is an exponential problem. Half a degree matters a lot. So this is probably something we have to keep in mind going forward. The extreme weather that we might see here and there are going to continue. It's something which is structural factor for inflation in our view. When we look at other factors of inflation, some are normalizing. That was something we discussed last time. If you look at this supply chain index done by the Federal Bank of New York, clearly we are back to pre-war level. In fact, we are not back to pre-COVID, but because there are still some supply chain, there are still zero COVID policy, and like I said, supply chain problems due to electricity shortages in Germany, in China, here and there. So this is not a full normalization, but we are already seeing a normalization of that going forward. What is at play today is an energy shock, obviously. You see that natural gas prices have been skyrocketing. Having said that, we see that there are some correction. We are below 200 the TTF this afternoon. Why is that so? Because we are now looking at this recession we are discussing right now, and the more recession scenario we have, the less demand of energy. I think of China. If China does a 3% of GDP growth this year, that would be great. And China is buying 25% of world energy. So if China decelerates, the demand of energy is decelerating as well. So the TTF, I will be back on that as well, is obviously a European phenomenon, a Russian phenomenon, if I may. But is it going to last? That's a question, because there is a supply, but there is a demand side of it as well, and that's very important in our view. The supply side is constrained by Gazprom and Vladimir Putin, but the supply side is very important to look at. Look at oil prices, same story, and oil prices are back to where they were before. So we are at 90. There is another issue, because we see that the oil producers are weaponizing in a way. It's not weaponizing, but are using it, are maximizing their profit as much as they can, because they know that in 5 years, 10 years from now, oil demand will be close to zero. So you have to maximize your asset as long as you can. So they try to keep oil prices between $90 or $100. So it's very difficult to imagine that oil prices are going to fall down, because as we speak, OPEC Plus is reducing its quota. So clearly, oil prices are normalizing, but I will be very surprised to see back to where we were on average. They should be averaging around $90 to $100 a barrel. We see as well a kind of a normalization of many metals for the same reason as usual. We see that in metals. We see that surprisingly, like I said, probably food prices are going to remain quite high. But we see that the food prices has corrected a little bit. The reason for that is probably about weight. We were expecting a big shock coming from Ukraine plus Russia disruptions. But at the end of the day, the production of wheat is not that bad. probably because part of the very nice production of wheat by the Russian is taken from Ukraine. We have seen that the shipping out of Crimea is 50 times bigger than they used to be, so probably they are shipping some wheat out of Ukraine to be sold elsewhere. But macro picture of that is that probably the production, the supply side of wheat is not that bad, even in France, a big producer, it is not there. But once again, big picture is not that. The big picture is that we see what's happening in India this summer with 54 degrees. So we were very close to the level where the human being cannot live, survive. But the result for that as well is on food. And we have seen that wheat production has been very, very much damaged in India. They had to embargo the exportation of wheat. So the long story is probably, once again, a bit different. But still, we see some kind of correction forward. We see that as well in all the demand of metals, exception being lithium. Lithium, we see that the expected demand of lithium in the next 40 years is multiplied by 40. So when we have that in mind, because of the electrification of the world, back to my first slide, if we need to electrify the whole world, we will need a lot of that, copper, cobalt, lithium. We can find some lithium, we can find some cobalt, we can find some copper. We don't have a big problem of stock. The problem is the way to get it, and everybody wants to do the same thing at the same time. But still, you can see copper and cobalt, probably the stock were a little bit too much, and we see there again the impact of this decelerating or this recession expected by everyone to dent into forward and spot prices of metals. Look at containers, look at the semi-Baltic, the Baltic Dry Index. There again, we are almost back to normal. That was something which was lots of debate around that. But at the end of the day, when we use big data, looking at the number of ships waiting in Los Angeles harbor or off the coast of China in Shanghai, we see that the backlog, the number of cargoes queuing is normalizing fast. So another indicator of this bag of bottlenecks that we have seen in supply chain are clearly now in the process of normalization. So all that is probably pointing toward less inflation going forward. If I may, I was mentioning wheat, and look at that, minus 40% from the peak. So this is clearly the case. Having said that, where do we stand? Where do we stand? We have seen Tuesday the number out of the US, sending the market in a rare event of the total sold-off, risk-off scenario with the 2-year yield north of close to 4%. So why was that so? Because we see that there is no deceleration so far of the inflation I was mentioning. So now where we stand at levels unseen in years, in decades, because if you look at that, in the 70s, in the US, for instance, we were around 7% on average in the 70s. We are above that, so we are clearly in a moment where central banks have to deal with some inflation, which is maybe linked to energy, maybe linked to special factors, but at the moment, the central bank have to be super reactive, or at least they think they have to be super reactive to that. So when we look more detail into the situation, and you have probably seen Patrick and I showing this graph before, there is a totally different situation between the US and Europe still. Maybe it's not going to last, but for now, it's very different. You can see that if you look at inflation in the US and the deflator of the PIB, you can see that there is some kind of overheating. And you can see that in job numbers. They remain quite good in the US. Look at the NBER, the National Bureau of the US, is not declaring a recession despite 2 successive quarters of negative growth, because we are in a situation where you have 2 job offer for 1 unemployed people in the US. It's not a recession-like an economy. Still, maybe it's going to be, and that's our scenario for the US. We expect a true, genuine recession before the end of the year. I will be back on numbers, and I will be back to say that when we expect a recession, in fact, it's not a big recession, it's a mild recession. It's a 2-3 quarter correction, but it's not something usual there again. But when we look at Europe, the situation still is quite different. But you can see, compared to the last time we spoke, that in Europe, this is a different situation. Half of inflation remains due to energy and food prices. But you can see that the underlying economy, you can see that wage increasing are starting to show. And we are in a kind of similar situation. Hence, it explains why the ECB probably want to be accelerating fast to encore to avoid disanchoring the inflation expectation of economic agents. You can see that in the wage inflation, as you can see in the US, that the nominal wages in the US are going to 6%. So this is a nice way to put it. If you look at inflation 2.5 points above that, you can imagine as well that you have a loss of purchasing power still, but you still have some nominal wage increase. If you look at Europe, this is the same story, but very different. Very different. We have this situation where we are going to have something like 4 or 5% on average inflation of wages in Europe. The ECB tracker, ECB has a tool to look at actual wage increases. They are at 2.2 at the moment, 2.14. So obviously for us it's too pessimistic or optimistic, depending on what side you are. I think it's going to be more close to 4 or 5% in Europe these days, France included. That's what our model is saying, that if you put unemployment, if you put inflation expectation, which is a good proxy of inputs for wage demands, and we are towards something like 4 or 5% in Europe. Going forward, this inflation, what does it mean? That means that you are having a very big loss of margin for companies and a very big loss of purchasing power for households. So all this, which is 70% of major economies' GDP. So obviously, this is pointing towards a negative for prospects for economies worldwide. US, Europe, or UK, obviously, is the same story. On top of that, where wages are going, if you look at that, you can imagine that, well, if you have some unemployment rising, and we expect unemployment to be rising in the US toward 5.5% early next year. So when you get that, you probably want to see wage demands to decline. But the problem is, both in the US and Europe, you have a record high number of difficulties to hire people. So it's in the US, you have something like 2 jobs for one unemployed people. In Europe, it's totally different. You have 3 people for 1 job, but it's depending on sectors. You can see that in restaurants in France, for instance, or in Spain, it's the other way around. You have a free offer for 1 people at the very least. So same story for Europe, in fact, is starting to see. So we probably, when we look at that, we're probably going to see some wage, like I said, 4 or 5%. Another aspect of that is that when a very different situation, like I said, between the US and Europe, there are lots of differences, and it's more energy linked to Europe. It's more wages in the US. The other difference is that in the US, the households have the net housing saving rate is already normalized. So you do not have any more buffer for your consumption. Hence, we expect GDP growth in Europe and in US, to be below Europe for this reason. Because in Europe, you still have some this excess of savings that we were discussing at length during COVID is still there very much. We are still having 160 billion of excess saving in France, for instance. So the consumption, even if you are some deceleration of economy, we do not expect consumption in Europe to be, or a country like France, to be very much in danger. Going forward, so we see this deceleration, the retail sales. If you have less purchasing power, you consume less. So a story that we see as well in many countries, including China. We see, even though the number were not that bad this morning, we see that the picture is one of a deceleration of growth due to inflation. What is strange in this environment is what the market is thinking. Is well, not strange. What is I'm trying to discuss this is that the market, in fact, is thinking that yes, we are going to see inflation in a few months again, but after that we see some normalization. We have that in the US, and we have that clearly in Europe. And you can see you have inflation 1 year, which is quite up, but after that you have a kind of normalization. Is it something which is possible? It's very difficult to imagine that we are not going to be back to where we were. I'm totally share the view that inflation is going to be cut by half probably 1 year from now for the reason that I was mentioning during when we look at energy. But clearly, probably we are going to enter a new regime of inflation, so probably higher than where it was before. So think of that. The average rate in the world in 2021 was 2%, is already 4%, so it's doubling. So again, another aspect of a recession due to central banks. It's not going to be in reverse 1 year from now. So the level of rates, the level of inflation is probably going to stabilize at higher levels than before. Europe, just to have some numbers, before 2019, for the last 10 years, it was on average 0.9% for core inflation. We're probably going to be closer to 3% of core inflation, meaning that we are not going to be back to 2% of inflation before end of 24, something like that. So next year we still have some inflation to be expected. One other big difference between the US and Europe, I'm trying to introduce the central bank story, is the following. In the US, like I said, it's mostly wages. In Europe, mostly energy. Why is that so? Because this question of energy prices is very much a European problem. You don't have the same problem with gas prices in Asia or in US. The gas prices in the US are 10 times lower in the US and 3 times lower in Asia than in Europe. So this is a global phenomenon, this inflation, no question of that. You have seen in Argentina, the central bank this morning hiking rate by 75, but it's not 75 BPs, it's 75%. So clearly this is a global phenomenon for lots of reasons, but there is a synchronization of inflation worldwide and a synchronization of central bank reaction. But still, you have some differences from here and there. Another big difference as well between Europe and the US is that in Europe, you do something very, very different from the US, where in the US you have central banks hiking rates quite rapidly. We are going to be at 4% very soon, and the budget, the government is reducing its efforts for the economy. We are talking about 9 points of GDP of less deficit in the US. The deficit is shrinking in the US by 9 points in 2022 compared to 2021. This is something that we have not seen since the end of World War II in 1946. So this is a big shock in terms of policy mix in the US, because both budget and monetary policy are doing the same thing at the same time. So lots of coherency here, where the policy mix is doing the same thing. We want to fight inflation to get some purchasing power back to the household. As opposed to that, Europe is doing a totally different things. We see that the ECB is now getting serious about fighting inflation. So we have seen 75 BP. My guess is that they're going to do 75 BP next as well. So they're starting to get there. But the budgetary policy in Europe is way different. Since the start of this year, year to date, we are close to 300 billion of spending by government to have this buffer to cap the prices of gas, of electricity, to finance oil prices, to finance the gas prices, and so on and so forth. So you have lots of money, and by the way, lots of money to sustain the carbon energy. So this is not a very good way to fight global warming. But what is very striking as a macro point of view is that you have the ECB doing one thing on Europe and all the government doing the other thing. So we have a bit of schizophrenia here, when on one side you are starting to decelerate the economy, on the other side you're trying to accelerate the economy. So something has to give. But the problem is that as long as the government are doing that, maybe the inflation can continue a little bit more. So there is every reason, if you look at that, to think that inflation can be higher and longer in Europe than in US. So the idea that the US is going to hike rates twice as much as Europe, you have to think it maybe twice. Probably the ECB is not going to hike rates like the Fed, but probably more than 2%. Like I said, inflation is very much an energy story in Europe. So this is very important. If you take France, for instance, and 3/5 of the story of French inflation is due to energy and food. So very much it's a commodity driven, and bulk of it is energy. So if you want to see where inflation is going in Europe, this is still very much an energy story. Now, energy, just to make the transition. We see that we have some big issue with electricity prices in Europe because, as you know, it's linked with the gas prices in Europe. The gas, the marginal consumption makes the price of electricity. So the last unit of energy used is fixing the price. I think everybody now is familiar with that. Well, now the highest energy in terms of price is gas. So gas is making the price of electricity. So Putin is making electricity prices in Europe. So we are going to change that. The European Commission is saying that they are going to come with a solution in October to decouple, to make things different between electricity prices and gas prices. But at the moment, this is not the case. So where we see gas prices and oil prices going forward. So Joël Hancock, our commodity analyst, and if I may, Joël is the top 3 of the world in terms of forecasting price of gas and oil. So it's quite interesting. And Joël, and we do have a very contrarian view to the consensus. We think that the peak of energy crisis, or at least the peak of prices for oil and gas, are probably behind us. In terms of scenario, we expect next year the TTF to average around 140, so far from the excess of north of 200 euros the TTF that we had before. We have a high case scenario, which is not linked to Russia. I will be back to that, but we do not care anymore that much about Russia, to be a bit provocative. We care a lot about global warming. So if we have a global warming, or at least the dislocation that we see in the world temperature, if we have a very cold winter, and again, global warming is linked to extreme events. So if we have a very cold winter, like in 2010, 2011 in Europe, then the gas prices and the energy prices might go up in this high case scenario. But the central scenario is for gas to normalize around 140 and to have Brent, like I said, around 100 the barrel, because that's where the supply side of oil, the OPEC countries are going to monitor probably oil prices. Why we say that? So it's because we have this deceleration of demand in China, in the US, and if we have a recession in the US, you see the gasoline prices in the gallon prices in the US going down, normalizing. Same in France. We are back to 150 for the pump prices. So we are almost back to where we were before the war. So there are lots of indication of that already. But another explanation is that what explains the high prices of gas in Europe was because Europe had to rebalance its supply of gas out of Russia into somewhere else. So they had to overpay LNG from the US, Algerian gas, Norway gas, Qatari gas, Norway, blah, blah, blah. All these suppliers, this diversification had to be made at a very fast speed to make up for the situation in Ukraine. So we had a forced buyers on gas in Europe. But this is over, in a way. This is over. A country like France, we are very close to 100% of stocks. It's 95% because we are selling gas to Germany, but even Germany, we are at 88%. So average in Europe, we are around 85% of stocks. And quite interestingly, it keeps rising in Germany, the stocks of gas in Germany, despite the fact that for now, a couple of weeks, we do not have a single gas coming from Nord Stream 1. So this is clearly showing that Europe has diversified its energy, one, and two, that the stocks are full. So we are with these stocks, we are able probably to go through a mild winter. We have three months of consumption with this kind of stock. So if we can import some gas from elsewhere, Norway, Qatar, Alger, LNG from the US, probably if the winter is not too cold, we are done for this year. So once again, it's a very different situation. Think of that. the share of Russian gas into total imported gas in Europe was 40%. Europe was importing 40% of its gas from Russia. Okay, today it's 8%. So in terms of energy mix, because gas is only part of the energy mix of Europe, it was roughly about 10% of the energy mix of Europe, which was dependent on Russia. Today, it's less than 2%. So what happens with the Nord Stream? I know that it's going to be much more complicated. We need some grid. We need some rebalancing. Maybe we need some big economies during the winter. I'm not going to say it's going to be easy, but probably the bulk of this leverage, that weaponization of gas by Putin and Gazprom is over. I think it's over. The other reason for that is probably that we have a lot of things pointing toward this direction. I'm trying to say that the peak of energy is behind us. For why is that so? Because, like I said, demand with the world decelerating is going to decline. Second, we have a diversification of gas imports in Europe. Three, a lot of efforts are being made in terms of saving of gas. We are saying that Germany can cope with the current situation if they save 15% of their consumption. Where do Germany stand? 15%. At the moment, Germany is consuming 15% less than they were doing at the same time last year. So they are already there, in a way. But more importantly, probably, is that we are accelerating big time in Europe in terms of renewable energy. This is something absolutely fantastic in a way. We have this acceleration of the story in this sense. Look at this graph, it's quite interesting. It's not inflation and ECB prediction or ours. It's in black, what was the actual number of photovoltaic addition compared to what was expected by, I will say, the EEA, the World Energy Outlook prediction, which is probably the benchmark on that. But you can see that every time we underestimate the actual installation of photovoltaic. Photovoltaic is accelerating big time everywhere. Same for the wind, same for, look at even France is starting to have some wind farms, 1 gigawatt, so it's the equivalent of nuclear energy. So it's accelerating big time. This is something very, very interesting. A lot of questions on photovoltaic, by the way, is to say that we do not have what it takes to get photovoltaic enough in this environment. Well, this is not true. When you look at the polysilicon capacities, we are well above 1 terawatt per year, potentially, while we have something like 200 gigawatt installed. So we clearly have what it takes. And another factor which is very important for French people is that one thing which is explaining a lot the big high energy and electricity prices in Europe is a problem with nuclear plants in France. You have 26 reactors which are shut down at the moment, or shut down or in maintenance, and it's not going to last forever. EDF is probably going to increase his capacities before January, so the start of the winter period. EDF is going to provide some more electricity, less than they used to provide because there are still some maintenance period, but more than what's the case last year. And probably as we move along the way, they have found some solution for this problem they have, and probably the new EPR2 Flamanville is going to be there. Again, I'm just saying that what we have seen during this winter with this crisis is not going to last forever. So more renewable energy, more nuclear energy, diversification. Stocks are full, so I'm not too sure that we are going to experience another bumpy period for gas prices in this context. And on top of that, Europe is coming with a big reform of the formation of electricity prices decoupled from gas prices. So for all this reason, clearly, I think we are going to see that. And look at that. It's not a European phenomenon coping with what's going on in Ukraine. It's a worldwide phenomenon. Half of the photovoltaic installed in the world are done by China. China is doing photovoltaic like half of it. If you look at wind, China is installing 1,000 megawatts a week. So they are accelerating very fast. Yes, they are doing some gas imports from Russia. Yes, they are doing some coal more than ever. But at the same time, they are investing like mad in renewable energy. So this is a worldwide phenomenon. So coming to that, what do we make out of it? So in this environment where we see a big shock, everything is black, everything points toward recession, inflation there to stay, and central banks are going to hike rates like never before, or like they did in the 80s. So what the market has done, well, is to be on panic mode in a way. There is no safe side, safe assets. The only safe asset we see is dollars. But even in terms of dollars, when you look at the stocks, if you look at the S&P, we are down in total return 16% since the start of the year. So clearly, everything is in red, but the dollar and some obviously the commodity sector. But this is a very difficult environment. That's a worse environment for a portfolio: 60% stocks, 40% bonds. This is the worst environment in terms of market total returns over the last 50 years. So it's normal if you have some trouble with your portfolio. It's clearly something difficult to navigate. This is a big storm. So where do we see in terms of number in this environment? Just to give you our view on central banks. In this context, obviously the Fed is going to do a third 75 BPs. I don't buy the story of 1 full point. I think the Fed is going to do to aggregate about 75 next week. And I think the Fed is going to continue after that 50 BPs, and we expect the Fed to be so north of 4% very quickly going forward. For the ECB, I'm inclined to think that they are going to go for 75, and after that 50, and there again we are going to end up close to 250 for the terminal rate of the ECB. Again, it's very accommodative, situation in a way. It's still very accommodative to have 2.5 or 2.5 in Europe, or 4% in nominal rate. In real rates, it's quite okay. It's still not that restrictive. In terms of euro dollar, as you can see, we are quite optimistic that this red differential story that we see with the dollar at the moment. Once again, Tuesday we see the inflation number not coming down nicely. So we see the 2-year rates up towards 4% in the US. Well, we can see that this is a red differential because the euro and the sterling is at the lowest since 1985. We see this red differential clearly explaining the name of the game is a red differential. Going forward, I'm not too sure that the Fed is, well, I'm quite confident that the Fed is going to be at the top terminal rate before the ECB, and we are going to see the peak of inflation in the US probably way before in Europe. To say things, we are very close to the peak in the US. We see some the Philly Fed prices, for instance. We see the unemployment situation decelerating in the US. So probably we are very close to the peak in the US still, while in Europe it's probably December, January, I don't know exactly, but around the turn of the year we shall be at the point, the pivot point for inflation in Europe. So all these point towards some kind of rebalancing of red differential expectation. So we expect Europe to be rebounding. Well, we have election in Italy, but it's probably already priced in. So in terms of long-term rates, it means that we are going to see lower rates in the 10-year treasuries, in our view, because we have this inversion of curve, bear flattening. As long as we expect a deceleration of economy and you have in the central bank which is fighting hard inflation, you can get rid of your inflation premium, you can get rid of lots of term premia, and you end up with a lower yield compared to today. So I'm not saying this is a crying buy for 2 years, 3 years in the US Treasury yield curve, but clearly we are approaching this point, and we start to see the yield above the dividend yield. So probably we are going to see some buyers stepping in at some point in the US. Story a bit different. So in Europe, since the high point of rates is probably mirroring inflation, which is forward. So we are not there where we think the ECB could be in terms of pricing. So the market is adjusting fast, but we might see something a little bit at the higher side in terms of rates. And you can see that we are still cautious in terms of BTP bond, and we see some tensions. But once again, we are not that worried about the Italian situation. Giorgia Meloni is clearly it's an extremist, but they want to remain in euro. They want to sustain Ukraine, so they're trying to put a lot of credential in their policies going forward. Why is that so? Probably because they have 190 billion, so almost 8 points of GDP of Italy, which is at the European Commission desk. So if they want to get it, they have to cope with the rule, and we see that Europe is much more showing its teeth against Hungary, for instance. So this is not a good timing when you have around almost 200 billion at play to do that. So I think the government, the principle of reality, the closer to governing you get, the more realistic you will be compared to what you are saying during elections. Credit spread, there again, if you have higher rates, decelerating economies, well, you need to see some higher rates. You need to see some default rates normalizing a little bit, but it's only a little bit. Why is that so? Because we see that in Europe, like I said, 300 billion of spending. You see that in France, you see that in Germany, in Italy, almost in UK. You have seen what it is. In Norway this morning, lots of millions and billions are put forward to protect corporates in this difficult environment. So I don't think we are going to see a normalization of default rate. And look at that. Yes, it's going a little bit higher, but really nothing to be too scared about. It's not a big crisis. Again, what I was saying is that if we have a recession, and probably we'll get here and there, probably we will get a deceleration and probably close to a stagnation, maybe a mild recession, but it's going to be a mild one. Going forward, maybe to finish with, I see my time is ticking up. There are lots of questions. I want to try to answer it. Maybe, so as I spoke about Italy, just one thing because it's lots during dinners you have lots of that. Well, Italy has been suffering of euro and so on and so forth. Well, one thing first is that you see that yes, Italy is probably at the same level of GDP that they were in 1999, but this is absolutely not the question for Germany, for Spain, for France, for Portugal. So it's not a question of euro, it's a question of policies, probably. You can see that for productivity. It's not a question of euro. It depends on your policy, and you see that in terms of productivity, Italy is below where it was in 1999. So it's explained why wages are lagging behind. So it's explained why you have lots of extremism as well, is that there is lots of losers in a sense that people are feeling a little bit betrayed by since the start of the euro, but it's nothing to do with euro. It's to do with a lack of productivity and supply side reform, most of it. What is very different compared to 2008, look at that in Spain or Italy, we are in current account surpluses. So the European crisis is the Italy exit is going to endanger the eurozone. While eurozone is much stronger with a federal budget of 750 billion. The central banks has a new mechanism. Once again, the central banks is hiking rates, but if you have to fight excessive spread widening, well, they are not going to do that before the election, but after that, probably they can be a little bit more active in my view. So maybe to conclude, here are some numbers. So once again, it's difficult to have some forecast. You can see that yes, a recession, why not? But it's more likely to have a stagnation. So we are very much more optimistic that lots of consensus in a way in this sense. The World Bank is saying that we might be at 0.5% of world GDP next year. We are not there. We are more around 2.5, which is a very low by any standard. 0.5 is a strong recession of the world. And why is that so? Because you have growing population, so the GDP per capita will be much lower if you had only 0.5%. Having said that, you can see some numbers. In the US, we are going to be at 1.4 max this year, with a Q3, Q4 very close to true recession in the US. And look at next year. 0.7% for the US next year, for the reason I said. Policy mix, budget plus monetary policy are both have the both foot on the stop pedal in a way, and no question for me that we are going to have at least a split Congress in the US. So difficult to imagine some budgetary spendings going forward. So US economy probably 0.7 next year. When you look at Eurozone, we are still at 2.4. A country like France is very difficult to imagine less than 2.4. The French government, the lots of institutions are are even a bit more optimistic than we are. And honestly, we have even if we have zero growth in Q3, Q4, we still end up with 2.6% GDP growth in France. So there you can see that at 2.4 we put some negative GDP growth in Q4, but Q3 it's difficult to be super negative. For those having the chance to be in France this summer, it was crowded like never before, and tourism in France is close to 9 points of GDP, almost as the manufacturing sector. So it's going to be okay, the consumption, I think, in the third quarter. So difficult to imagine something lower than that, 2.4 in France. So it's twice as much as a regular GDP growth for France. So again, it's not that bad. The big drag in our scenario, the big alternative scenario, is depending on Germany. You can see that we have, at the start of the year, we were at 4.5 for Germany. We are at 1.1 for this year, and we are at 0.5 next year because of this energy crisis in Germany. Lots of production is stopping, and so on and so forth. So if we have more than that, if we obviously, if you have 1 point less of GDP in Germany, you can have at least half a point less in France, a little bit more than that. So we were very much close to stagnation, but this is not our central scenario even for Germany. China, we can't see how China could be doing more than 3% this year. So this is a very strong deceleration. US, Europe, US, China, you can see is divided by 2 or 3 compared to last year. This is a strong deceleration. But in China, next year we expect 5%. I was discussing with John Wei just before, our Chinese economist. I was a little bit challenging the 5% figure, but at the end they say, well, we expect some kind of relaxing of rules for the zero COVID after the Party Communist Congress. And there are lots of backlog as well. So as long as you are able to restart a little bit your economy, you can easily be at 5%. Make no mistake, we expect GDP growth in China next decade to be below 2%. So we are not very, very bullish on GDP growth in China. But next year, it's not that worse. So it's why probably we have a big difference with an institution like the World Bank. So you see that we see a deceleration of growth for this year. It's not that bad, in fact, globally. And next year, we have a strong deceleration, but we might be avoiding a true recession. If we have a recession, once again, it's not 2008, it's not 2001, 2003, etc. It's a mild recession, if I may. And look at inflation after what I was saying regarding energy prices and the peak of the energy crisis. Well, probably we are going to be still well above 2%. We are talking about 5.8 for Eurozone, but we are coming from an average of more than 8%. So it's starting to decelerate as well. So probably the bulk of the rate hikes, and things that central banks are acting 80 months forward. So the bulk of central banks' rate hikes are going to be made before this year end. So it's going to be probably the bulk of that will be done going into next year. So we will be showing our expectation for next year fully the 6th of December with our next year outlook. But for now, what we see is, yes, recession is in every media, in every word. Well, this is obviously not impossible at all. This is likely, probably, but our central scenario remains a little bit more cautious on this matter. Thank you very much. I'm going to try to answer a few questions. Some questions regarding commodities. Regarding maybe the relationship between commodities and ESG, so the green transition and prices. The link between inflation and renewable energy for me is twofold. It's probably super inflationary in the short run. It's probably super deflationary in the medium long-term run. Why is that so? Because there is no cheaper energy than wind and solar. The new solar bifacial solar panels that we are looking at, we are talking about 18 euros a megawatt. When we look at the wind farm in Nord Stream, I don't know the pronunciation right, but in Dunkerque or in Saint-Nazaire in France, we are talking about 49 euros a megawatt. So if you compare that to 500 euros a megawatt today, obviously the renewable energy is much cheaper. problem is that it's a little bit like after the COVID, the whole world is going to do the same thing at the same time. We are talking about a world which is 70% fossil fuel energy. We have to move to 70% of electricity. So we need lithium, we need copper, we need that. Et en passant, this is a big change of geopolitics. The world is going to be less dependent on OPEC and oil producer, and more on countries which are having the resources for electrification. So lithium, cobalt, copper, things like that, rare earth and so on. So the new OPEC countries, the equivalent will be Australia, will be New Caledonia, will be Chile, will be Indonesia, will be China, Russia as well is quite rich. But we see a lot of countries, the geopolitics are going to be changing massively going forward. The International Energy Agency is saying that the GDP per capita of OPEC oil producer is going to be diminishing by 75% by 2030. So it's going to have a massive change of geopolitics. So to answer your question, well, inflationary in the short run during the rebalancing. So let's say I can't see that in less than 5 years. But after that, it's clearly deflationary story. It's much cheaper to produce energy from wind, solar, or even probably nuclear. Nuclear, we are depending on what you are putting in it, but between 50 and 100 euros megawatt hour. It's more like 50. If you take the EPR2, you are around 50, let's say, to be optimistic. To be gentle, but clearly the renewable energy is much cheaper than current gas prices or energy prices. Which are your views on the expectation of European Union to limit the effect of energy prices? Well, what the European Union has decided is to cap the prices for energy producers not being oil and gas and coal. So it's the renewable energies to be a cap at 180 euro. So it means that you cannot benefit from much higher prices than that. Obviously, when you are at 49%, you have probably seen that renewable energy producers in France are giving to the French government 11 billion, I think, in public finances, because in fact they are getting a lot more money than expected due to the very high electricity prices. So clearly that will have an impact. The second thing that the European Union is doing is to have a super tax on profits by energy companies. So they are not concerned by this cap, obviously, because they are above that. Well, it remains to be seen as it's going down, but still there is a super profit taxes on energy producer of oil and gas of 33%. Every single individual country is allowed to go higher than that, but it's going to be mandatory to at least have 35% from the European Union. And the third thing that the Europe is doing, like I said, is trying to have a decoupling between gas prices and electricity prices. All in all, in terms of magnitude, and we are talking about 100 or 150 billion of revenues by European Union in a sense sum of individual members. So probably is going to finance part of this buffer that individual governments are spending to protect households from energy prices increases. But there's an interesting question as well of the link of that with ECB and Fed, and this is very interesting because in fact inflation in a country like France is 2.5% less than in Europe because of this lots of spending that the governments because the French government is doing, and we're talking about 25 this year, probably 40 billion in full year, 43 billion next year again. So you can see that inflation is lower, but because we spend a lot. So in terms of policy mix for the central banks, for me, it doesn't change a lot the picture. The truth, the truth of prices clearly is a bit above. So in my view, the ECB or the Fed, it's a question for the ECB because the Fed has not this question. The government is not doing that much for that. The government in the Biden plan to fight inflation is much more about financing renewable energy, and this is a deflationary story at the end of the day. For the ECB, what's going on today to see a lot of spending is probably not going to change the picture to have to anchor inflation lower, and that is something that the government is doing in a very different way. Today there is clearly a nuclear threat. No, we don't take that in the scenario, the central scenario. We have lots of alternative scenario, but a war going nuclear or a nuclear plant exploding, we don't put that in our scenario. We are obviously very scared of that, but this is not something that we can put in a central scenario. Well, we can put in a central scenario, but it's very difficult to today. High inflation, salaries not being increased that much. What if the consumption? What if the consumption collapses? Don't we expect such scenario? Well, it's true that we see high inflation and not that high wages, and we have a loss of purchasing power. It's why we have this deceleration of GDP growth, especially in the US. And 70% of the GDP is consumption. So if this is explaining exactly why we think the consumption and the saving rate is already down, because the purchasing power is lower. So yes, we have that in the scenario in a way. The big difference in Europe clearly is that we still have some saving capacity, saving rate, excess saving due to the COVID period, which is still there. So it's a little bit buffer contrary to that. But yes, this is clearly what we have in our scenario. What we are in our numbers of deceleration is because of consumption, investment for sure, profit margin of companies for sure. Clearly, the double-digit earnings expectation that we have in the stock market in Europe, for me, are very, very optimistic in this context, because yes, the household is losing purchasing power, but companies with wages going up and GDP growth going down and the prices of inputs going up massively, well, the margin has to decline apart from the energy sector, obviously, but yes. I think my time is already there. Time is ticking up, and this is 1 hour already. Sorry for having been a little bit long and a bit late as well at the start. I'm sure that we can do that again with Patrick very soon. He's okay. Sorry again for this change of program. This is the new world we are living in, and thank you very much for joining in. What I am sure is that we are going to have this outlook the 6th of December, but by then we will be soliciting your time in many occurrences. I hope to see you and hear from you soon. Bye bye.